Facebook, Amazon, Netflix, and Google. These social media giants are some of the world's biggest publicly traded companies. Collectively, they're called FANG stocks, and on Wednesday, concerns over their financial health took a bite out of stock prices. The Dow Jones Industrial Average lost a staggering 600 points, wiping out this year's gains. And the Nasdaq turned its worst performance since August 2011. Yet some analysts remain optimistic.
This looks a lot more like a correction to us than the start of a bear market. We've seen a lot of exhaustion in terms of the selling.
That didn't keep the contagion from spreading. Australia's stock market added $35 billion over the past 12 months. All of that was wiped out in Wednesday's trade. Japan's Nikkei fell nearly 4% to end up at a 6-month low, and Hong Kong's stock exchange shed more than 1%.
We lost something like 500 points today and falling below 24,000. And I think Hong Kong market is really very close to bottom, because when you look at the valuation, it's really extremely cheap.
Not all major stocks are faring badly. Microsoft shares rose nearly 6% thanks to better than expected sales, and Boeing shares soared more than 2% higher. But the World Bank and the International Monetary Fund have raised red flags over rising trade protectionism.
We see a distinctive slowing down here at the stock exchange. The markets are under pressure, and that is due to the overall situation. Many of the topics are with us for some time. Trade war, Donald Trump, also Brexit, which burdens investors. But the main topic at the moment is rising interest rates because of inflation. We see that clearly on the US, and that leads to a regrouping and nervousness, which will stay with us for some time.
The US Federal Reserve's actions may force central banks of other countries to push up borrowing costs, and that would give investors even tougher news to chew on. Mobin Nasir, TRT World.
And David Levine is the founder of the investment company Odin River and joins us live now from New York. Welcome back to the program. The last time we saw this sort of volatility was just 2 weeks ago when the Dow plunged more than 800 points in a day. Last time, higher interest rates were being blamed for that volatility. What's the reason this time round?
Well, it's great to be back, and I do think that the higher rate environment is having pressure on various different securities, especially things that are sensitive to interest rates. So if you look at the U.S. housing sector, it's under pressure, for instance. But we're also seeing a global cyclical slowdown for the first time in a long time. So if you look at automotive companies, semiconductor companies that have been reporting over the last week or so in earnings season, they've showed fundamentals are slowing. And so I'd say it's both the higher interest rate environment, as was mentioned, kind of inflationary fears related to trade, but also slowing global fundamentals. And when you get those three combined, it's not surprising that you see stocks selling off as violently as they have been.
And after the last sell-off, as well as higher interest rates, the US President Donald Trump also said that this correction was a long time coming. And some other analysts have said that the tech sector particularly was probably overvalued in some cases. Is this your view as well? Are we seeing a correction that had to happen?
Sure. I mean, if you look at the global picture, it's actually even more striking. When you look at outside the United States, you have countries like China in a bear market. As you know, Germany's near a bear market, and one of the only strong markets in the world year to date has been the U.S. And then within U.S., tech has kind of been the sole remaining source of strength across most of the indices. Nasdaq has been the strongest index. And if you look at certain stocks, they were up over 100% in the first 6 months of the year, certain internet stocks. So yes, it's long overdue, in my opinion, that we have a correction. But again, that doesn't mean that it's kind of a fully complete correction. A pullback, is kind of the beginning of just a temporary correction, or what I think is more likely, it's the beginning of maybe a changing tide of the broader economic picture and also the broader market environment. So in my opinion, it's probably just the beginning of what's coming.
Okay, yes, because I guess investors have been used to an environment where they've been making a lot of gains in equities, and the bull market has lasted more than 10 years, the longest in US history. So are the good times finally over then?
Yeah, and I think that 10 years is the longest bull market, in recent memory, and this market has been inflated by various different things, including extremely low interest rates. And so quantitative easing, as you know, has turned to quantitative tightening in the United States. Europe just confirmed they're also stopping quantitative easing, and so all good things come to an end, and this bull market seems like it's coming to an end as well. So I would say yes, I think this is, when you have the S&P 500, as of this morning, it's risen now, but as of this morning, the S&P 500 in this month was down more than any other month since 2009. And so I think it is a changing of the guard. I think, all good things come to an end, and we're entering a new transition to lower valuations across the board, in my opinion.
Interesting. Okay, David Levine in New York, thank you as always.